In this video, traders, we're looking at other levels that big players watch. Stay tuned. Hey guys, warm welcome to you. All right, so we know that big players move the market. They create a supply-demand imbalance just purely by the amount of size that these guys are throwing in and around the market. So what are the levels that they're watching? Now, we know that some of the levels they're watching are going to be highs and lows, maybe intraday highs and lows, maybe prior-day highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows. They're fixed, and we know the close as well because of the gaps, etc. So we know there's lots of activity around that, but they're the obvious ones, and maybe key levels of resistance and support to some degree. But what about other levels that we don't think about that they may be watching? Well, one of the things that very often occurs is a magnate, if you like, or a real adherence to a whole number. So why does this happen? Well, if you look at the commodity markets where this tends to happen more, is that, you know, if you think about how a commodity works, you've got supply, demand side, you've got consumer, producer, and a lot of their business that's done in the commodity markets is hedging from the consumption side or the production side, not just speculating from us. And when they're doing that, their calculations are probably going to be, hey, we don't want to pay more than $50 a barrel for our oil, so we're going to buy and we're going to stop buying at $50 because the numbers work back, mean that that's our profit for the year, or whatever. You get the point. If we're selling it, maybe we don't want to sell. So you find that the market just happens to stop at these whole numbers because they're significant for people who are doing business, because $50 24 cents or something is, you know, almost doesn't make sense to them. You think about the people who are involved in making these decisions, the board or whoever's sitting there saying, hey, we need to hedge this, blah, blah, blah. Okay, what if we did it at $52? What if we did it at $55, $50, etc.? They're probably thinking more in round numbers than we might be as sort of traders who are, fine-tuning things. And also, let's not forget, it happens in the equity markets as well. For one key reason is that because of the options are tied to strike prices, and the strike prices aren't infinite. They aren't at, like, let's say you're talking about a SPY S&P 500 ETF. They're not at 301.28. They're going to be at the whole number, and the majority is going to be at the higher whole numbers, like 300. You know, that's a lot more size going to be there than, say, another number. So the idea is that you've got to think about what these mean to people. So the whole numbers are super significant, right? The other thing, guys, the other level that big players watch is they anchor price to an event. So what does that mean? So if, for example, we had a scenario where, okay, interest rates have been cut, Fed has cut rates minus 25 BPS, okay? For example, that level there, and I doubt would go down from there, but you get the point, something, ISM numbers, some kind of non-farm payroll numbers, whatever it may be. And let's put raising rates, actually, because that will be more likely. Big players are then going to extrapolate a line out forever and say that was the price where we had interest rates at X, because this is plotted on various other charts, stuff on Bloomberg, etc. It will show them, hey, this was the last price of the market, whatever market, this is gold, S&P, when the Fed cut rates or raised rates in this example. So when they go back, when we get price maybe 4 weeks later coming up to here, and no one's even looking at it, the big players are, because they're saying, okay, now we're in territory where, this was where interest rates were in a different environment. This is where non-farm payrolls are in a different environment. Same for things like earnings, same for things, anything that's impacting that market, they will have marked on their chart going forward, because it's important to them, because it's their benchmark of there's a benchmark of success as well. It's like, okay, well, this is where the market's performed since interest rates were hiked. This is where we are now. This is our performance. And you start to think this kind of stuff. Okay, so other levels the big players watch. We talk about whole numbers. We've got to watch those whole numbers specifically in the commodity markets as well, also in the equity markets, because they're tied to the options. We talked a little bit about anchoring to actual price points, as in Fed said something, some sort of deal was done, some sort of general election was changed, or some sort of fundamental change of events. And the final thing, guys, that the big players watch is, on an intraday basis, is the VWAP. You may have heard me talk about this so many times before, but honestly, it's super important. Now, are we talking about big hedge funds moving massive money around? Not per se. However, there are many algos that are tied to VWAP. When a hedge fund or a big institution says, hey, I want to buy 100,000 shares of this stock or 200,000, whatever it may be, at the VWAP, what that means is an algo will go out there, and indirectly the hedge fund is looking at VWAP because they've given it to an algo. An algo will trade more and more buying as we go under the VWAP, and it'll start to not buy so much as we go above the VWAP, as long as their average price is there. So as price moves away from VWAP, let's see our VWAP starts to move down here, they'll pick up the buying, which is why we don't go too far, comes back up, they'll shut off the buying, and then that's why sometimes we tend to see the price oscillating around a VWAP on a quiet day. So VWAP on an intraday basis, yes, they might not be intraday trading, but very often when they are executing large orders, they are going to use the VWAP. And so that level then becomes very, very, very much in the focus of the algo, which is executing on behalf of the hedge fund. On an intraday basis only, guys, VWAP on an intraday basis. Although you can program sometimes on the charts and anchor it from a certain point. So you can anchor a VWAP from a certain point, and a chart will make a calculation based on that, so you can have it longer term. But generally speaking, it's on an intraday basis because algos are judged, if you like, on whether they be VWAP, whether they got VWAP, and some actual algos guarantee VWAP. I know that some brokers, if you're executing a certain amount of size on a very liquid instrument, will guarantee VWAP because all they have to do is slice the order amongst, and if it's a small enough order relative to the size of the day, they can slice it anyway and just kind of use that, and that becomes self-fulfilling then. So VWAP, anchoring the price point based on some kind of event. And the whole numbers are 3 of the extra levels, key levels that bigger players will watch. Take care, guys. See you in the next one. Bye-bye.